next would be the chart of accounts. So to get there, you'd go to transactions, chart of accounts. What the chart of accounts is the list of all accounts in your general ledger, or you could say in like accounting, your accounting general ledger. This also tells you where to put this account, whether it's going to be like the sum of these transactions is going to be on your profit and loss statement, or if it's going to be on your balance sheet. So most of the time, if you need to edit your chart of account, it's going to be to add accounts for expenses. That would be, I would think, the majority of the time. And the way that you would do that is you'd go to new. I'm going to just briefly explain what these mean so that you have an understanding when you're adding an account. And so, like I said, the most common is your expenses. So you have your income and expenses. These two types will go to your profit and loss statement, which is what determines your net profit, which is what you get taxed on. So your income minus your expenses gives you your net income. So these are what is going to impact your taxable income. Then you have banks. That's a balance sheet. Then you have assets. That's a balance sheet. Credit cards is a balance sheet. Account liabilities and equity are your balance sheet. So the first two are going to be impacting your profit and loss, and then the rest are going to be impacting and presented on your balance sheet. So when you first click, okay, save account under, this is in case, well, if it is, let's click income. If it's an income account, it's going to give you all of the accounts it could possibly fall under. So when you first look at it, you want to review and say, okay, do I already have an account that would best summarize certain transactions that you're wanting to categorize? And if you've reviewed and you're like, well, I guess it would be other income, then instead of creating a new account that then you're going to know it's going to be other income. So the way I would look at it is you have your income account. So your primary income account it's either going to be income or sales or services. So your primary is always like income, services. If you sell products, then it would be sales of product income. So in this case, let's say it's income, then most of your, or I think earlier we said services, sorry. So services, then all of your deposits will likely go to the services account. Other income includes income that is not primary income. It's income that's not directly associated to the nature of your business. Like it's not a recurring thing that you're in business for or to do. You just received that other income. So in this case, what's already in the chart of accounts is interest income and PPP loan forgiveness. That's what's relevant to this company. Expenses, same thing. You always want to look at save account under, and when you're reviewing this, if it's already there, then you don't need to create a new account. You just have to use the account that's already there. So cost of goods sold are going to be expenses that have a direct impact. For example, if you're a real estate broker and you have to pay contractors, then most of the time you want to separate your cost of goods sold, like the cost directly associated with producing that sale. You want to see that separately from your operating expenses, which would be the ones under expenses. So if it's like a job that you had an expense, a direct expense, like a labor expense for, you'd want to use one of the cost of goods sold accounts so that you could see what your actual gross profit is before operating expenses. But if you don't have any of those types of costs, then most of the time your expenses are going to be under the expense title. And you would again review to see if the type of expense you're looking for is not already there. Now, let's say you've gone through this list and it's not in here. I'm trying to think of an example. Let's say you, okay, let's say it's a rental vehicle, like a rent vehicle. I don't think I see transportation. Nope. And you're like, well, I have airfare, lodging, and travel meals, but I also rent a car. So, and I rent a car and I pay for fuel. So then you would click because you want it to stay organized. And so you want it to be a sub account, is what you would call it, of travel expense. So you click travel expense, yep, and it's travel related. And then you would call it vehicle rental expenses. And as you see, QuickBooks tells you what it's going to look like and where it's going to fall under. So you do want it to fall under travel expense, vehicle rental expenses, and then you would click save. Okay. And it would add it to your chart of accounts. If it wasn't a sub account of any account, then you don't see it falling underneath any that already exist, and it's a completely separate, I don't think continued education. Yeah, so like some people invest in continued education, then if it wouldn't really fall under any of these, then you could select expenses and you would say, I don't think education. Nope, or training. Nope. So you would say other business expense. If it doesn't fall in any of these, like it's not related or associated, you would do other business expense and select training and education. And it shows you where it would fall under, and it's just alphabetically under expenses. And you'd click save. Now let's say you had you're adding a new checking account. Then you would click banks and go under bank, under bank account. And what kind of bank account is it? Let's say let's just say it's a savings. Then you would type in the name. Like, let's say it's a Wells Fargo savings. And it shows you where it would fall. Another common, let's say an asset's typically an expense that you made for the business, but you can't deduct it all in the same year that you purchased it. So let's say you bought office furniture. Let's say it was a $3,000 desk, really expensive desk. Then you would go under assets and you would click. Typically, those have a life between 3 to 5 years. So we would call that furniture. Furniture, original cost. Okay. The cleanest way to do it is you would click under furniture and fixtures, other fixed assets. That's right. And the account name would be office furniture. Let's say it was the well, furniture and fixtures. I guess in this case where you would book that transaction would be under original cost. It would be under original cost. So let me go here. Okay, original cost and do desk. Now this is if you don't have that many assets and you want to keep track easily for tax purposes, then you would specify what it was. But if you don't need to see that level of detail on your balance sheet, then you don't need to create a new account for that. Most of the time where it's most beneficial is, let's say it's a vehicle. You bought a vehicle for the company. And so would go under vehicle, and it would be a vehicle, and I would go ahead and say, okay, I bought a um Ford Ford F1, was it Ford F-150, and put the year that you purchased it, so 2023. Then it would fall under vehicles, and it's Ford F-150. You could do a start date and an end date, but it most of the time you have issues trying to reconcile what QuickBooks is telling you and what your tax return tells you. So I don't fill that out at all. You just put the name, make sure it's under vehicles, and hit save. Like whatever down payment you made or whatever, it's like the cost, like the down payment that you made. And then you or your accountant would help you book the entry on adding that asset based off of your actual agreement that you received from the dealership. But that's one example. Credit cards, it's self-explanatory. Whatever you already have. Let's say it's a Wells Fargo credit card. You would click credit cards, and you would say Wells Fargo. And you can add the last four of the card to make it easy to identify. Then you have liabilities. So in addition to credit cards, let's say you took out a loan. Then you have an accounts payable. These are short-term payables. Other current liabilities, if it's a short-term loan, meaning under 12 months, then you would click under here. But let's say it's a long-term loan. It would go under long-term liabilities. And in this case, this client has a Chase line of credit or a financial. So if it's, let's say it's a Wells Fargo line of credit, you would hit long-term liabilities, other long-term liability, and type in the name of the account and just make sure that it's falling in the right spot. And lastly, you have equity. Equity is the equity depending on the type of entity and how you report taxes. So if you're a sole proprietor, a partnership, an S corp or a C corp will highly depend on how you create accounts in the equity section. For equity, let's say you're a sole proprietorship, you'll just really be using open balance equity for any beginning balances of your accounts when you first link them. But primarily you'll be using owner draws and owner contribution. I would always split it between what you contribute and what you draw. So if you're just creating, if you noticed in the chart of accounts, there's only shareholder equity, contribution, and distribution. So that's for in case you're an S corp. But if you're a sole proprietorship, then you would create an account under owner's equity. And your first account would be, let's see, I would call it owner's equity because it's not in here. You'd call it owner's equity, and then you would create that account first, hit save. And then underneath owner's equity, you would do owner contribution and then owner draw to show when you put money in and put money and take money out. That's if you're a sole proprietorship. If you were a partnership, then you would create an account called partners equity, and you would call it partners equity, and see how it creates that similar to what shareholder equity would be, but you'd have partners equity, and underneath that you would have, their partner one, but you'd actually put their name like partner John Smith or J Smith, contribution, partner J Smith, distribution, and then partner. So you would want to put them as partners. It's always easier for reporting purposes if you have the contributions and distributions separated. So I'm going to just give an example. Let's say you had two shareholders. So I'm going to go to shareholders equity. And I'm going to go to equity. And you would call it John contributions, John Smith. Or actually, what would be easier is if you do John Smith. And save it. And then create a new one. Equity under shareholder. Whoops, owner's equity. Under John Smith, you're going to do contributions. So you would first create the John Smith account, and then you would create contributions. And then create the distributions. So new equity under John Smith, create distributions. So then anytime you have a contribution from John Smith, you would type in John Smith and you would select contribution, or if you had a distribution. So it would be, I spelled that right. Yeah, okay. So I've gone over each one with examples of what would fall under each category. And when in doubt, you can, if you're not sure where a transaction goes, let's say you had, let's pretend you don't know where Overick. Let me see if that's a vendor. No. Let's say you looked and you don't know where it should go. There are accounts, and you can choose which account you're going to use consistently, called uncategorized expense, or you should have Ask My Accountant bucket, and you would click Ask My Accountant. And anytime you're unsure of which account it would go to, then you would put those transactions. You add the payee, right? Overick management. Oh, it's already there. Already exists. So you can go to categories. Actually, it's not telling me. It's not telling me. Then I go to vendor expense, vendors. It's not actually there. Okay, so then you'd hit Ask My Accountant, and it would put that transaction in one account so you can go through with your accountant to determine where to put it. That concludes walking through the chart of accounts.